What about silver? Well, that we haven't hit we haven't broken through the trend line yet, and we haven't hit resistance yet at about just below 5,000 ounces. Maybe that's 4,900, 4,800, something like that. But here's the trend line from 1980. We can see here we were about, what is that? Maybe 1,700 ounces, maybe 1,500 ounces in 1980. I don't know exactly what it is. But we have to break through 10,000 and get through this trend line, but we will, and we'll see this number fall faster than it will in gold, and we should break below the 1980.
Rafi Farber, a respected voice in the precious metals community, has issued a compelling analysis of the evolving dynamics in the gold and silver markets, arguing that both metals are on the cusp of a historic monetary transformation. With gold hovering near $4,000 and silver approaching $50, Farber sees these price levels not as speculative spikes, but as symptoms of a deeper structural breakdown in the global financial system. He highlights the extraordinary surge in silver inventories at COMEX vaults, doubling since 2024, as a key indicator of this shift. Importantly, much of this silver is classified as ineligible for trade, locked away by large, anonymous holders. Farber interprets this silent accumulation as a calculated response to waning trust in paper-based assets and an early signal of a potential monetary reset, as the dollar continues to lose credibility and central banks face increasing stress. What makes this cycle different, Farber explains, is the unprecedented correlation between rising prices and growing inventories, a phenomenon unseen in previous bull markets. This signals that the accumulation of physical silver is being driven not by retail speculation, but by entities seeking protection from systemic risk. As fiat credit markets falter and the demand for real collateral surges, Farber believes silver is poised to reclaim its role as a monetary asset, prized for its utility, divisibility, and historical credibility. Looking forward, he predicts a rapid repricing event where silver could exceed $100 per ounce and gold could break above $5,000. Farber emphasizes that this won't be a slow, multi-decade climb, but rather a sharp, disruptive revaluation triggered by a sudden collapse in trust, an endgame scenario where only physical assets retain value. Now, we present the clips from Rafi's interview. Before we continue, please subscribe to our channel and activate the bell icon to receive timely updates. Thank you, and enjoy the video.
Gold is at 4,000, silver is at 48.50. When you look this good, you don't need to know anything.
Hey, when you look this good, you don't have to know anything.
But anyway, more about that on the Endgame Investor on Substack, and I will try to figure out the mystery here. But either way, this is not going to continue. I don't know how much longer it has, but if we go to the COMEX, what is going on with COMEX silver? This is the silver supply going back to 1971, looking for any kind of pattern that can explain what is going on with the silver supplies. You see here the spike since the beginning of 2024 from about 8,000 tons to now 16,543. The silver supplies in New York have basically doubled in 2 years. That's scary, and all this silver is going offline because a lot of it is going into cold storage, not for sale. There's some for sale. There is a good amount of silver for sale against contracts and the registered supplies, but a lot of it is ineligible, meaning it's not for sale. These are humongous whale stackers. We don't know exactly who they are, but they are piling up huge 5,000 ounce bars, and we don't know why. But if we look at these little rectangles, and I made them thin so you can see what exactly they are bracketing here. This is the 1980 run from the end of 1979 to the beginning of 1980. That is the big spike over here. What was happening in the silver supplies? They were kind of going up. They were going up appreciably, but nothing compared to what they are now. So there wasn't much of a move there because in 1971 or 1970, silver supplies were much higher than they were in 1979, 1980 in New York. So not that much of a correlation there. But here we see that as silver supplies were going up from about 1980 to 1993, you can see that the silver price was falling in a descending triangle from about the beginning here in 1983 to 1993. And around here is when, what's his name, Buffett, that guy, what's his name, Warren something. He stood for delivery of silver around here. And then the silver supply started draining, but there wasn't much move in the silver price. So we don't see much of a correlation between the silver price and the silver stacks in the COMEX vaults. Same thing in 2011, there wasn't much of a correlation at all. You can see here the move from 2010 to 2011 from, it looks like about $12 to $15 or whatever it was, to 50 in a matter of months. Not much movement in the silver supplies here. They went slightly down, but nothing alarming. And here is where we see what happened from 2020, from the lockdowns, those glorious medical miracles that saved all of our lives.
Gold standard of safety.
To 2022, silver was going down, the silver price was going down, and the silver supplies were going down. But here is something that we haven't ever seen before, and that is a doubling of the silver supply with a more than doubling of the price. So this is the first time we are seeing silver stacks move up in the COMEX and the price also go vertical with it. First time we're seeing that. What does that mean? It means something new is happening here. What is happening? Well, the dollar is collapsing, and that's going to lead to silver becoming money once again, because once credit collapses, there's no other way to exchange other than with money itself, because everything else is a derivative. But where is the demand coming from? Is it the ETFs? Not really. Here is a close-up. We're going to go into the farther out, zoomed out chart in a second, so you'll see this isn't much of a climb. It is a climb. It's not much of a climb. But you can see here, the last 3 days, we've had these 3 bars over here. If you total this up, it's about 17 million ounces in 3 days have been drained from the ETF. 17 million ounces go out of the ETF, go back into the vaults, either in London or in New York. They're able to do this because there isn't that much retail demand for SLV or other ETFs. Otherwise, they would have to stack silver in the ETF to keep it in line with the silver price. The fact that this is going down means there is less demand for ETF for retail traders because they're just not interested in silver yet, because it's not going high enough fast enough, but it will. So no demand in the ETFs, no demand in the physical markets for the stackers, because as I said, I just had an interview with Brian Kuzmar, who said the spreads are far apart, which means there is no activity and no demand. Here I wanted to go into silver squeeze. But we can see here the ETF demand. The only movement that ever increased ETF demand substantially was silver squeeze, excluding this part over here, which was the post-lockdown frenzy for silver. That really was a huge move in the silver stacks. This is the amount of silver in the SLV ETF. It went up from about the lockdowns to about the middle of 2020. I think that's August 2020. And then it stayed kind of steady until silver squeeze and then fell. So if we look back at the 2010-2011 rally to 50, we can see here there was a little bit of ETF demand, not that much. It was slight, it was appreciable, but it wasn't humongous. It wasn't anything like this, right? So we can see here that even the 2011 rally did not have much of an effect on the ETF demand. It had a little bit, but not that much. The only thing that had a big effect on ETF demand was silver squeeze. That was it. And here is the move from silver from about 27 to now 48, so about a doubling in the silver price. And here is the move in SLV from, what is it, 400 and maybe 40 million ounces to now 487, so about 45 million ounces. That's not that much. There hasn't been much demand in SLV. So once these 3 cylinders get going, meaning physical markets and ETF markets and whoever's stacking in New York, who appears to be continuing to do that, imagine where the silver price will be then. It will be in the hundreds, and that could be relatively soon, which is, I think that is the low here in 2011. This is September 2011 when gold hit a bull market top over here, and then had a bear market over here. But now that is done. We hit like a triple, quadruple, whatever top here. Couldn't get through that resistance, and now we are below 120 ounces of gold per house. I expect this to go down to the 1980 level of that looks to be around 70. It's going to get lower than that in Weimar. Remember, it took about a $100 bill to buy a swanky house in Berlin. That's about 5 ounces of gold. I expect that we will go there for a time. It will not be sustainable and it will not be sustained, but for a time, you will be able to buy a nice sized house for about 5, 6, 7 ounces of silver. Exactly what it will be, it won't matter, because the stackers will have much more than that, and it won't even make a difference. What about silver? Well, that we haven't hit we haven't broken through the trend line yet, and we haven't hit resistance yet at about just below 5,000 ounces. Maybe that's 4,900, 4,800, something like that. But here is the trend line from 1980. We can see here we were about, what is that? maybe 1,700 ounces, maybe 1,500 ounces in 1980. I don't know exactly what it is, but we have to break through 10,000 and get through this trend line, but we will, and we'll see this number fall faster than it will in gold, and we should break below the 1980 line here. If we do get to the Weimar area, then you should be able to buy a decent house for about 75 to 100 ounces of silver for a short period of time. At that time, you don't want to necessarily find the best deal. You just buy whatever is available because everybody needs silver, because there's no other way to divide labor, because credit doesn't work, which is why prices in silver will be so low at that time, because of the desperation for real money with which to divide labor will be in desperation levels. UK real estate, just wanted to look at that. These are all from Gold Charts R Us. UK real estate is pushing 100 ounces of gold for a house. This is the average in all UK property price. I don't know how exactly accurate these are. These are estimations, but you can see here the trend is obvious. We're going to break through 100 ounces in the UK. One more chart, UK housing in silver. You can see we broke through 10,000 ounces. We're at 9,722. And we have a trend line. I didn't actually draw it here. I think we're right on that line from 1980. If you draw a trend line here, touching the 2011 high, and then touching here, I think we're right on that trend line, but it doesn't really matter. These things aren't exact.
In a global environment where confidence in fiat currencies continues to deteriorate, Vince Lanci emphasizes that gold and silver are reasserting themselves as the foundational pillars of real money. The current financial upheaval in Japan is not an isolated event but a symptom of a larger, systemic issue. As the yen weakens, investors aren't simply fleeing to the US dollar as in previous cycles, they're increasingly turning to gold. This shift signals a deeper recognition that all major fiat currencies face similar vulnerabilities tied to debt saturation and unsustainable monetary policies. According to Lanci, the surge in gold beyond $3,900 and silver nearing $50 is not driven by speculation, but by a growing consensus that precious metals offer the most reliable protection against inflation, currency devaluation, and financial instability. Lanci sees this moment as a critical inflection point in global financial history, a slow but accelerating collapse of trust in central banks and their ability to manage economies without triggering unintended consequences. He points out that G7 nations are trapped between choosing economic contraction through austerity or further weakening their currencies via money printing, and history shows they almost always choose the latter. As these pressures ripple from Japan to Europe and elsewhere, investors are waking up to the reality that paper promises can no longer be trusted. In that environment, gold and silver are not just hedges, they're becoming monetary lifeboats. Lanci argues that the current rally is not a temporary spike, but the beginning of a larger structural revaluation that could redefine the role of precious metals in a world where the very definition of money is being rewritten.
Beginning of true capital flight that's mistrusting of safe havens that are not gold or silver. So mechanically what's happening is domestic people in Japan are taking their money out of cash and putting it into stocks. They're taking their money out of bonds and putting it into stocks. That has essentially no effect on the yen. Foreign investors are taking their money out of yen, and they're either doing that by using the yen to buy Japanese stocks or converting the yen to dollars or another currency. The conversion to dollars historically is bearish for gold. The dollar is stronger, and gold, which is a neo-Keynesian slave to the dollar correlation, drops. But what's happening now is, and this has happened many times for moments, for 30-minute windows in the past, and that is when the fear in Japan gets big enough, the people that are taking their money out of the yen, they don't just put it in dollars. They say, you know what, I'm going to take my money out of the yen and put it into another currency. But then they realize that this isn't just a Japanese problem, it's a global problem. So they'll put less money in dollars and they'll put some money in gold. They'll put some money in other currencies, whatever. But the point is, there's a growing number of people that are skeptical on the ability of any fiat currency to withstand what's going on in Japan. What's going on in Japan has already started to happen in the UK. and it's starting to spread. And so you're in a situation now where the dollar is stronger because people are selling the yen to buy dollars, but they're not selling the yen to only buy dollars. They're selling the yen to buy gold too. And this is quite literally the manifestation of what you've been concerned about or thinking about, these past 30 years. And that is the manifestation that the markets are slowly starting to realize there is no Santa Claus. And speaking financially about it, the markets are saying, wait a minute, there is too much debt. We understand that now, and we recognize the only way out of the debt is to either bond yields have to go up because the bond yields have to compensate us more for the debt to take the risk of borrowing, or the currency has to weaken its buying power to compensate for the low yields, right? And the way to hedge both of those is to take your money out of the bond market, take your money out of the currency itself, and put your money in the companies that use the currency to make more money. Because the theory is, and the theory is largely true in normal and market environments, is that if the currency is being debased, then you can raise the prices on your goods that you're selling. So the Japanese manufacturer will have more money that he's making because people have more money to spend from inflation. So if the yen is weaker, he'll just raise the price in yen. That's a normal environment. In a bad environment, and we're not there yet for Japan, at least Japan's mentality, they realize that the companies can't raise prices fast enough to offset the debasement of the currency, and people don't have the money to actually spend because it's all being steered by the government into where they want it to go, and the companies end up suffering. But that's another conversation. So, in sum, what's happening in Japan is framed as Japanese because of the new election, because the government's probably not going to play well with the neo-Keynesian governments, with the other G7s. You have a conservative prime minister coming in. And that means an acceleration of revealing that we have a problem here. That means higher yields in long-term bonds for the Japanese. That means they may have to go back to yield curve control. Depends on how they do it. I'm not sure, if they want to go back to that or try something different, something that I'm not familiar with. But the world is seeing a slow motion contagion. What happened in the UK is happening in Japan. And if it's happening in Japan, it's probably going to happen in every G7 currency to one extent or another. You can't spend more, borrow more, and expect your economy to do the same without inflation. If you stop spending, you'll have a deflationary collapse. The deflationary collapse will be most noticed in stocks. So you got to keep the pumping stocks up. That in the past worked in every government in the G7 because people believed it would work. And so gold only benefited marginally. But the belief is fading, and as the belief fades, more and more people are turning to metals. Now in Japan, that's the financial relationship of what's going on now. Japan itself, you're starting to see more and more headlines about Japanese dealers running out of metal, and that's been happening since July. We wrote about that, but it's going to get more headlines now. So these are realities that you've already been apprised of, and they're now becoming front page because people are ready to think about them. So I guess the moral of the story here is you were right. It just has to get to a certain point for other people to see that you were right about something. And sometimes that point doesn't come for years, but it's starting to happen now. The choice for the world, the Western world, and probably the world by virtue of that, is either we spend less or we debase the currency. So if you want to have the quality of life that you have, you either have to spend less which means you don't have the standard of living you have. You downsize to a smaller TV, you tighten your belt, because more of your money is going to be spent on defense, more of your money is going to be spent on social safety nets from all the immigrants, and you learn to do without. You get put on a budget. But governments can't do without. Governments can't ask their people to go on a budget because they've coddled them and spoiled them, and those people don't have the psychological stamina to hold it together, being told to do without. Essentially, in the West, we're spoiled. And the fallout of that is when you have a spoiled West that's been told, trust the nanny state, and you have a nanny state that desires to be in power more than anything else, then they will never vote for austerity. They never vote for tightening your belt or being responsible. They just vote for throwing more money at the problem, which is exactly what happened in the 70s, until all of business took its money out of business and put it in gold.
The world appears to be approaching a financial turning point where confidence in paper money and government-backed systems begins to unravel, forcing a return to assets that carry real, intrinsic value. As the cracks widen across global markets, nations and investors alike are quietly repositioning themselves for a world where scarcity and stability matter more than speculation. This shift is being signaled by record central bank gold purchases, rising physical demand, and growing interest in tokenized forms of tangible wealth, each a step toward a new monetary foundation. When trust in fiat inevitably falters, the next era of finance may blend ancient security with modern innovation, where gold and silver once again anchor value, and digital technology ensures their reach across borders. In this future, wealth will no longer be measured by printed numbers, but by assets that endure beyond political control and economic illusion. Do you think the future of money will return to real assets like gold and silver, or will digital currencies take full control of the financial system? Share your thoughts in the comments section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.